Welcome, everybody, to the Tuesday edition of the Not Your Average Investor Show. Today, we have the director of the Passive Income Club for Fortune Builders and principal of Equity Street Capital, Paul Shively, who's going to go over how to decide which loans you pay off first, how you dramatically increase your positive cash flow by following a simple loan payoff strategy, and review real-life examples live on the show to see how clients can shave 3 to 5 years off of their timeline to reach financial freedom. Don't forget about your ability to be able to be live on Tuesday for the Not Your Average Investor Show on Facebook. I completely muddled that up because I was trying to play it into the conversation. I'm your host, Pablo Gonzalez. With me, as always, the man that generates cash flow, the man that has genius concepts, the man who's a great co-host, who we call GC because his name is also Greg Cohen. Say hello, Greg.
Everybody, great to be with you.
I am way off on my intros, but you know what? I got something special for our guest today because he is the returning star of the Not Your Average Investor Show. He's a world-renowned real estate advisor. He's the director of the Fortune Builders Passive Income Club. Despite a storied sports career, he has yet to defeat GC or me in volleyball or spike ball, which we're getting really, really good at. Gets mistaken for Jason Statham on the streets of Southern California on a regular basis because of his looks and his 4th degree black belt in real estate investing. He's the principal at Equity Street Capital, which has over $1 billion in assets. That's a billion with a B. And he's the returning star of the show, Paul Shively. Welcome, Paul.
I don't even know what to say. That is the best. Can I pay you to just in the morning, can we FaceTime together and you do that to just start my day? That would be, you may have a second career there, my friend, or third or fourth career. That was pretty impressive. Holy moly.
I will happily accept payment for those services. And Paul, I will give you a good deal. I give you a very good deal.
Good deal. I love it. That's awesome. Thank you. Thanks for having me, guys. Yeah, this is fun. I had so much fun last time that I just had to come back. I was begging. I was texting Greg, banging on his door. His wife was like, Paul Shively, leave my husband alone. He needs to parent our kids. Stop begging him to be on the radio show again. So thanks for having me back. I appreciate it.
You know, man, stars got to shine out here, man. And speaking of people coming back, we now have a new tradition that we hadn't done before when you were here. It's our roll call where we welcome our Not Your Average Investor Show community. We got Bill Shields in the house with a buenas tardes, damas y caballero. We got John Henning with a good afternoon all. Leo from California with a good morning. Carl Thompson's back with a good morning, everybody. He said he's been held up with work stuff the past few weeks. Good to have you back, Carl. We got Hetty Pritchard back from South Florida, my South Florida native sister over there, Hetty. Dean Curry is back. Good afternoon, everybody. Eddie Harris from Atlanta is back. Eddie, we hadn't seen you in a while, man. Good to have you back. Alejandro Lopez, good morning, all. Alex from California. Maybe you guys know each other, Paul. I don't know. Lee Bishop is back. Good afternoon, gentlemen. And like the Fortune Builder swag. That's right. Is that? Are you wearing Fortune Builder swag right now? Is that what's going on?
90% of my closet is Fortune Builder swag. So yeah, probably. The odds are. And if it's a polo shirt, it's Fortune Builder swag.
Whatever's free. I'm into it. Drew Barnhill's here. Good afternoon, everybody from Atlanta. Also, Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
She's back. Welcome back, Marilyn. Who else we got? We got Saul Zuska is back from beautiful San Diego, California, somewhere that Paul's very familiar with. We got Jake Hargrove with a yo. He's back in the house. We got Jag Chatta. Good morning. Per Francois from New Jersey. Randy Dunn from Simpsonville, South Carolina. Man, we got the fam in the house today. This is awesome. As you all know, this is an audience-generated show. We want you to be part of the show. 2 ways to do it. One is to do what you're doing right now in the chat. You just got to make sure that you are talking to all of us by making that blue box above where you're saying it, everyone, as opposed to just hosts and panelists, because if not, only we see it and we lose the genius of everything you're saying for everybody else. You can make a new friend. The other way is the Q&A box. You pop that open, put your questions that you want asked on the show to GC or to Paul and his $1 billion worth of assets. So that way I can keep track of it and I can make sure that it happens. If not, I go cross-eyed trying to keep track of everything. And last but not least, if you are here to learn about rental property investing, you're in the right place. If you're here to find out about asset management for rental properties. I'm really having a hard time speaking today, but you're in the right place. And if you're a real estate professional that wants an edge in the Jacksonville market and maybe find some extra opportunities for you and your clients, you're in the right place. Next place to go is chatwithjwb.com. When you're done with this call, or right now, go set an appointment, hop on a call with the team. We can customize something for whatever you're up to and give you everything that you want to know. Lee Bishop is saying, I have rented lips today. You're right, Lee. I don't know. I've never heard that expression before, but it makes a lot of sense. I'm a
Lee calls it like it is, man. I think that you haven't been in front of, our full group in quite a while here. It's so nice to have 40, 50 folks here right now. So, you're a primetime player, Pablo. It's time to step up and work on those rented lips you got.
It's the group. It's Paul's incredible abilities that just has me a little nervous today. But today we're talking about some the other thing is I talk about it. I'm kind of just like, I play a real estate expert on TV. I'm not really one. I'm with two right now. We're going to talk about some advanced techniques on debt pay down and how to decide whether or not you want to pocket that money, pay down your loans, go into those kinds of things. I guess I'd like to kick it off to you, Paul. When you first started investing in properties, at what point, how many homes did you have already in your portfolio? How much did you have under management? At what point did you really start contemplating, should I just cash out refi? Should I add debt? Should I pay down? Should I do things with the money? At what point does it start really going through the investor's mindset of like really having to think about this stuff?
Yeah, it's a really, really good question. Hopefully sooner than it did for me. Learn from my mistakes, I'll say, right? And for many of us, who are doing things like being on the show, getting educated, getting that financial education and investing in education as well as building their portfolio, hopefully that comes a lot sooner than it did for me, right? Who kind of was school of hard knocks, right? I had to have some really smart people come along me, namely Than and Paul, bring me up to speed, like Than Merrill, Paul Sajan, bring me up to speed and kind of slap me upside the head and say like, hey, you got to start thinking about this. It's not just real estate. We're not just doing transactions here. What we're doing really is kind of what I now call financial engineering, right? So what I love, and actually like real estate, I love it. It's amazing. It's an amazing vehicle. It's an amazing tool, but it's a widget that I can do really cool things with because I have learned the skill and been taught the skill and study. I think my skill is financial engineering. How does money work through the vehicle of real estate, right? And that's what really got me excited. Gosh, I started when I was like 2021, kind of building the portfolio. It was around 24, 25. So it took me 3-4 years, right? To kind of understand the game, understand money, and begin to understand how money flows and works, where we did the types of things you're talking about, Pablo. Let's learn about how to cash out refinance, which I know we talked about on the show. Previously we now have a calculator and a tool built just for that to help people do that. How to understand and calculate, okay, do I need the cash flow from this, or what happens, a little teaser, what happens if we don't take the cash flow and put it towards my mortgage? What'll happen? Let's play around with that math. And I never was good at math until it started making me money. Let's be very clear. I was horrible at math until it started making me money. And I was horrible at Excel and spreadsheets. They overwhelmed me until it started making me. And I saw like, oh, wow, I can make a lot of money if I get good at this skill. And so it took me 4 or 5 years, 3-4 years to kind of wrap my brain around it. And now I just got asked the question the other day, what's kind of the definition of passive? And for me, it's a little bit different. It's changed early on. When you're building your portfolio, you want to be almost completely hands off. You want someone to kind of really do everything for you. But once you have that sizable portfolio, you have 5, 10, 15 properties, you're getting to maybe 20, 25 properties, you're getting to be kind of in that millionaire type range, becomes a decent amount of time where you want to spend on the financial engineering aspects of analyzing your portfolio, not the day-to-day, taking a step back and saying, what moves should I make with my money? And then that starts to become hours, but it's fun hours. It's fun because then you get to really grow things exponentially. So
is that a passive investor's game, right? Like this idea of like financial engineering, like is there any space for the financial engineering piece when you're being really, really active, or
Totally. And Greg, I mean, you can jump in here too. Is your take is like, I'd love to hear your take. We never talked about this, Greg, but my take is, yeah, for sure. Like financial engineering, in my mind, it's just understanding how money works, right? And what the rules are of how we can take the rules that because we all play by the same rules, right? Like the SEC, the IRS, they set the same rules for all of us, right? It's a matter of how do you take advantage of those? Not in the wrong way. I'm not trying to take advantage as a loaded term. I'm just using the system and the rules the right way to get the result we're looking for. You can do that whether you're doing the BRRRR method, right? Like you're buy, rent, renovate, doing it actively yourself. That's financial engineering to the nth degree, in my opinion. If you're doing the rehab, how do I raise money from this source, put it into this vehicle, which is a rehab, build it up, get the money back out, pay these. I mean, that's fine. You're moving money around. That's financial engineering at its tool. I mean, that's a best case scenario of what the tool does. And in the rental side, when you're passive, it's a slower game, which is what I like, because I like the steadiness and stability and strength of the slowness of the growth, where it's less risk because it's so slow, in that it's a long-term portfolio building aspect. And I have time. It's not like I've got to time things exactly perfectly. I've got time to build my portfolio, make these decisions, right? If I do it, and do I need to time my refinance the right way? No, I mean, anytime in the year to 3 years, you can do a refinance. No big deal. The longer you wait, sometimes the better. So financial engineering, in my opinion, it impacts all areas of the business. It's a wonderful tool and knowledge to have, in my opinion. Greg, I mean, do you agree? That's my take.
100%. I mean, if I boil down where the value proposition is to work with a company like Fortune Builders on the active side, or JWB on the passive side, or, the value proposition for our type of firm is that we love that financial engineering, and we can create value for you by doing that. Some of you are just naturally numbers people, and the financial engineering component for you will come naturally. And being here on the show, especially as we go through this exercise today, where we're going to show you just through effective debt pay down strategies, how we can shave years off of your plan here. This will come naturally to you. Some of you will look at this and say, this is foreign to me. Whichever bucket you fall into, the ability to work with somebody who can financially engineer your real estate assets or whatever assets you're in is such an important part of your team. And, that's much more than just what a realtor does, right? Or that's much more than what just a property manager does. You want to align yourself with folks who you can say, hey, listen, I've got a goal here. I've got a pile of money. I trust you. I'm going to give this money to you through these investments that we are going to do. Maybe I buy them from you, or whatever the investment may be. I want you to return that money back to me by a whole lot more of a margin there, right? Notice there that they're not continually saying, hey, how do you give me more money? How do you give me more money so I can get your, it's taking that same original pile of money that you plan to invest and then maximizing that, right? Growing that. That's really what a financial engineer is. It's a beautiful thing for you to be able to work with somebody who says, yeah, you know what, that original plan we had, that pile of money that you said you wanted to invest in this, listen, by us doing this a little bit differently, by us doing that a little bit differently, we can drop this by 3 years or 5 years or 10 years for your overall plan. I mean, that is the biggest value proposition for working like with somebody just like Paul.
Makes a lot of sense to me. And you referenced an exercise that we're about to go through, right? And this is something, quite frankly, audience generated to the max, right? Lee Bishop had asked for this in our group a couple of months ago. We heard him loud and clear. A couple of people were in on it. And there is this technique. I think, Paul, you guys have a name for it. C3X, I believe it's called, or the waterfall technique, or something like that. It is an exercise that we're going to walk everybody through. But before we pull up the spreadsheet and walk everybody through it, Paul, is there any kind of like framing that you want to talk about the building of the spreadsheet or the mentality going into it?
Yeah, for sure. Number one, if spreadsheets freak you out, don't worry about it. I got you. Okay. It's all good. They freaked me out too, like I said, for a long time, until I realized I can make better decisions and I can make more money if I figure out how these things work, right? I'm the kid who failed calculus in high school, and I was bad at math until it made me more money. And then I got really good at it, right? So it's all good. Secondly, C3X. So C3X, what is C3X? It's kind of an homage to one of the gentlemen who was the original creators of this strategy with us at Fortune Builders. So Noah Cosby is kind of one of the OG Fortune Builders guys, right?
Absolutely.
So it was myself and Noah, and we were sitting around talking, and Noah had built a nice little portfolio for himself. I shouldn't say little, wonderful portfolio for himself. And JWB, you and Greg, you were a huge part of that, huge part. And he jumped on the phone, went through his investment objectives with you, went through the whole process. And it, like you mentioned, Greg, it wasn't transactional, right? It was plan-based. And that's the biggest difference, right? Like when you get someone on your team who's just transactional, their fees and alignment, it's just, they want you to do the next transaction. When it's relationship-based, plan building based, financial engineering based, which is what it was with Noah, we start throwing around ideas of how do we make this grow, right? So what Noah was sitting there like, okay, let's take the basic concept. I can put a mortgage down on a property, right? Put 20, 25, 30% down on a property, get some really good debt. Like right now, we can get really good debt on properties, really good low interest rates. And I'm going to pay that debt off over 30 years. And I'm going to net some cash flow in the meantime. Okay, cool. And I can rinse and repeat and do that and stack up. You know, we have a concept called stacking. Buy at least 1 to 2 properties per year and just stack them. 4 or 5 years later, you're going to have a nice little portfolio for yourself. And he's sitting there and he's looking at it, and he had it all. Noah's a spreadsheet guy. So his dad, actually, so Doug Cosby, who actually works in our accounting department here at Fortune Builders, Noah has a saying, no weekend was complete without his dad sitting down with a cup of coffee over a good spreadsheet, right? Like he was that kind of guy. So Noah inherited that a little bit, likes tracking everything. And Noah just, and he came in one day, he's like, hey, I have this idea. I want to start playing around with it with you. What happens? Because I don't need my cash flow, right? My $100, $200, whatever it was. I don't need it every month. What do I do with it? And we came around, well, what if we just pay down the debt faster? What if we take this and just, okay, I'm going to take all my debt and I'm just going to pay down each mortgage faster. What happens? Well, some simple math. Let's just say we take a 30-year mortgage. We take all our extra $100, $200 a month. We just pay it towards the mortgage faster. Well, that would mean I would shave off some years, right? So let's say round numbers. Let's say we cut it in half, right? And we, instead of 30 years to pay it off, it's 15 years to pay off my 10 properties. Cool. Well, what happens? Well, instead of having a mortgage, I get more in cash flow. So maybe I go from a couple $100 a month to 700, 800, 900 bucks a month. Sweet. Right. So instead of waiting 30 years to get it paid off, I can pay them off in 15. My cash flow goes up because I'm deferring gratification, which he can afford, he could do because he had income coming in. He's like, sweet, this is awesome. And then about a week later, I said, no, I got an idea. What? I don't want to wait 15 years. I'm impatient. I was like, let me show you something. So we built this all out. What I'm about to show you, we built it all out. We paid quite a bit of money to have it built out with some engineers and everything who understood the math and did a lot of stuff. Basically, we paid a lot of money, got this thing built for us. And the concept was very simple. It asked a simple question. What if instead of paying all of our mortgages down at the same time, what if we just focused on one, right? So we have 10 mortgages or 8 mortgages or 2 mortgages or 5 mortgages. Doesn't matter. Concept's still the same. What if we take all of our cash flow and we just attack one mortgage in our portfolio and get it paid off as quickly as we can, right? What happens? Now, remember, all the other mortgages are still being paid. Yes. It's not like we're not paying anything. We're paying our normal mortgage. This is extra payment to pay it down faster. Take our whole portfolio's cash flow and just attack one. What happens? And the results were pretty insane, right? And what it's, if you are familiar with the concept, it's basically a debt snowball, right? It's the type of idea, like if you have like Dave Ramsey out there talks about paying down your credit cards and your debt, like your bad debt, right? Paying it down, you know, you attack your first one that's got the lowest balance to get that off, and then it just snowballs from there. We applied the same principle to this, and the results are pretty insane. frankly. It was pretty cool. And yeah, we're able to, depending on how much you throw at it, much more than 3 to 5 years, we shaved off plan building, which was really, really, really pretty cool. So.
Absolutely, brother. I love how you brought people along. I remember that journey. I remember with Noah's first properties with JWB. And then I remember how excited we all were as we actually got the numbers to work to show that plan that, a lot of times, we have been in the game for a long time. We knew certain of these concepts, but just seeing it numerically, how it will reduce the number of years to pay it off with this strategy in place has been a game changer. And one other thing that I wanted just to bring up is, for folks that invest in rental properties, most people are so concerned with the things that matter the least, right?
Yeah.
They are so concerned with the property that they are investing in, and they don't pay attention to the property management team, which over the long haul, you win in real estate by holding on for the long haul, and you need a team to support you. The team is much more important than the property, which, like Paul mentioned, is a widget. So they've got their focus misplaced on that end. If we go one level farther, when they come to the decision to buy that property, they focus specifically only on cash flow day one. And that's their driver of what is a good deal. And they totally keep blinders on. They don't pay attention to the other 4 profit centers, which over the long haul will actually be more impactful. So this exercise that we're going to go through is going to show you why there's so much more to pay attention to that you can do to really improve your financial situation beyond just the property and beyond just the 1 year cash flow. You can take the same investor who makes the same decision to buy the same properties in the same market at the same time with the same numbers. And by going through this type of financial engineering, we can have an investor that winds up 10 years earlier reaching their financial independence, which is really cool. So the value of this is going to be, I think, really wonderful for all of you who own properties right now. And then for those of you who are planning on buying right now, knowing that you can kind of take this strategic approach to debt pay down, I think it's really, really helpful and is going to probably surprise a lot of you. So with that kind of a buildup, brother, why don't we jump in?
Yeah, for sure. And one thing, I saw some of the questions, and hopefully it's okay. I don't know if I'm following the rules or not, but some of the questions they pop up on the bottom of my screen on the chat, which is cool. Like, so some of the questions were like, can you show me the spreadsheet? Can I get access to the spreadsheet? Who can walk me through the spreadsheet? So like, Greg, your team, I mean, we built this, but we're partners. I've given this to you. I've given this to your team, right? Your team can help walk people through all of this, right? And jump on the phone, pull up a spreadsheet, throw their properties in there, walk them through how it works, all of that stuff, right?
100%. This is what our calls with our clients, especially annually when we go over your plan and make sure that it's the right plan for the next year. We can run this calculator for you. It's so much fun.
Yeah, so much fun. Cool. All right. So let's start nerding out because I love nerding out. Wow. Let's do this. I'm going to share my screen. Bing, bang, boom. Boom. Pablo, Greg, you guys see that?
Looking great, brother.
Oh, hold on. I don't think I optimized it, Pablo. Wait a minute. Let me undo it real quick. I'm going to unshare.
While you're unsharing, Paul, Jack Chatta has a question here. He says, and this is kind of what I was asking you before, but I asked you in a more personal way, but do you start this strategy after you build up a certain number of properties in your portfolio, like 10 properties, or is there what's the point? Like what's the point where it makes sense to start doing this? I mean, does it make sense with one to start making this calculation?
Oh, for sure. Absolutely. Right. Absolutely. I live by a credo of 2 parts prep, 1 part execution, right? Measure twice, cut once type of thing, right? All that. You can say it 15 different ways. You can never have too much planning. You can never have too much education. You can never have too much knowledge of what this financial concept is. Where you can get in trouble, where I would get in trouble, was paralysis analysis, right? Like that's where I would get in trouble. And I would warn people you never want to wait till all 15 stoplights are green. Make the first one be green and just go, right? Go, start investing. Time is your best friend when investing. So like, just get going. But you don't have to wait until 3 properties, 5 properties. 10. No, you can do this you can do this concept with 1 property, right? It applies everywhere. So
yeah. Greg, is this kind of when people go to chatwithjwb.com and like their first discovery call, Is this something that you walk through a couple different scenarios and you start talking about this stuff, or is this after you?
We talk about this, right? Probably our second or third phone call. We're talking about the 3 stages of rental property investing. So the 3 stages are you're in your acquisition phase, right? You need to buy the number of assets that are going to help you reach that financial goal that you have, that monthly passive income goal. If you don't have a certain number of assets in your portfolio, you're not going to reach them. So we have to get you in that acquisitions phase. The next phase is the debt pay down phase, which is exactly what we're talking about here. And then the third phase is distribution, which is a fun phase, right? That's where you get to enjoy the fruits of your labor and the fruits of your investment, usually after a number of years. And then you can decide if you want to invest more or if you want to pay down debt a little bit more aggressively. So that's the cycle there. So yes, we talk about this in concept right in the beginning. We talk about the value of financial engineering right in the beginning. And then as you're a client long-term, typically, after the dust settles on your first investment properties, we can start to take a look at this, but usually it comes along with kind of the planning process, which is, usually within the first few months of becoming a client or definitely within the first year.
Yeah. And I love that answer because, and I know, people want to get into spreadsheet, we will in a minute, but it's a really good answer because there's no, as sexy as this is, as awesome this is, everyone's different, right? Like probably we talked about it before, like my dad's portfolio, my brother's portfolio, my portfolio, the portfolio I have for my kids, they're all different. Because they have different investment objectives and different goals, different time horizons. So like, that's what I love about Greg's answer. It's dependent upon each person. It's part of their plan building process. So like this strategy can be applied full force to some people. Some people, it may be a smaller part of their strategy. They should still do a part of it. Some people, no, this won't apply, because everyone's different and unique. And that's why, like Greg, the point you made earlier is so important. It's not just transaction based, right? Like build the people around you, build the team around you who is not just talking about the next transaction, is talking about the plan and your investment objectives, because it's different for everybody, right? So, all right, should we get into the nitty gritty? Should we nerd out? Let's do it. Cool. So what this is, we built this, in like I talked about, in coordination with Noah. Don't get freaked out. There's a lot. Don't get overwhelmed. It's all good, right? So really simply what this does is it allows you to put in, your properties, and you put in, let's just take property 1 as an example. So, when did you buy it? What's your first mortgage date on the property? Then when's the first payment you make? Property address, property 1, really unique name we came up with there, Greg. Property 1. What'd you buy it for? What'd you put down on it? What's your mortgage on it, right? What interest rate? How long is your loan? AKA how many months? 30 years is 360 months. Most loans are 30-year loans, right? 360 months. And then what's your payment? So this, if it's gray, automatically calculates for you, which is nice. White, you put the information in. Gray, automatically, the magic Excel wizards behind the scenes and the little elves move the math around, do it all for you. Guys like me love that. Then what's your net cash flow? What this shows you, you can put your properties in 1 through 5 through 10 through 15 through 20, whatever you want, right? It's all good. What's your portfolio? What this does is shows you very simply, okay, what's my current cash flow, right? And then what's my current portfolio's return? But like we talked about, well, what happens if I start paying things off? Well, once I pay things off and I don't have this pesky mortgage payment anymore, I go from $1,000 a month to basically 10 grand a month. Big difference. How do I do that as fast as I possibly can? Like we talked about earlier. So this is where C3X comes down to. What C3X stands for is Cosby, Noah Cosby, like we talked about, compounding cash flow. So there's 3 C's, Noah Cosby, compounding cash flow. We're taking our cash flow and we're compounding it towards just one loan. And this does the math for you on that, which is pretty cool. So with no C3X, no Cosby compounding cash flow, right? We pay off all of our loans in 30 years. That's it, right? 30 years. Well, what if all of a sudden we do this drop down and we say, yeah, I want to do C3X, and just, we'll go through the rest in a minute, but I want to do C3X, which is my lowest loan balance. We attack that one first to get that snowball going, like we talked about, right, Pablo? So boom, I click on that. Wow, this property is paid off in 2023. Not 2047, 2023. That's a big difference. Holy moly. How many years is that, Greg? My math is rusty. We went from 2047 to 2023. 20 plus years. It's a big deal, right? Big deal. Wait, maybe 15, maybe 18. I don't know. Whatever. How many years? Whatever. We
carry the niner, carry the niner. 24.
We took from 360 months, we paid it off in 60 months. Just by saying, hey, my investment objective is to get to this 10 grand number, 9 grand, 10 grand, 8 grand, 2 grand, whatever your number is, as fast as we possibly can. And if I don't need the cash flow that Greg or JWB or any of the companies that you're working with that give you every single month, I don't need it. I can defer gratification. Let me pay it towards my mortgages, pay it towards one mortgage first. We went from 300, we knocked off 300 months. Get that first puppy paid off. Here's the cool thing about it is it starts to accelerate. Once that first one is paid off, right? Then we have extra cash flow, right? We show this as an example. Instead of netting $100 a month, you net, the total. You're going to net, 800, 900 bucks a month, 950 a month because you don't have that mortgage to pay. Well, then that adds to what I can shuttle down towards that next mortgage and pay that off faster and then pay the third one off faster. And it accelerates and it builds like a snowball. Once you get that thing rolling down the hill, it builds and builds and builds. So pretty soon you're paying properties off in 10 months, 15 months, 20 months, in less than a year. Sometimes you're paying properties off if you follow it long enough, right? So what it did is we could build this whole portfolio. And the reason these are out of order, you see property 2, property 5, property 3, because remember, it's attacking the smallest balance first.
Yeah. Paul,
so this calculator, go ahead.
Can I ask you to zoom in maybe on that lower?
Oh, yeah,
that lower
for
part?
sure. Is that better?
I think so. Let me know in the chat. Right. It just got a little bit blurry. So
yeah, sorry about that.
It's clear again. All right. We're good. Yeah.
So what this does is it attacks the lowest balance first. So it automatically calculates which one's the lowest balance. Let me take all my cash flow and shuttle it towards that bad boy. And how many months does it take to pay that bad boy off? Right. And what's cool is you can do this with 2 properties, with 5 properties, 15 properties. It doesn't matter. It's the principle of the thing. So don't get hung up in the numbers. It's the principle, right? So what we did, remember, let's do the shift. No C3X. I'm just going along. I built my portfolio. Things are great. I'm doing awesome. Following what Greg's telling me. Pablo's cool. I wish I looked like that when I'm 55. Things are awesome. I don't know how old you are. I'm just going to keep going, right? I'm just taking my cash flow and I'm not really doing anything with it. Cool. Now, all of a sudden we throw financial engineering in it. I don't want to wait 30 years to get to 10 grand. What if I take my $1,000 a month in cash flow that I'm getting from this portfolio? Don't get hung up on the number. Don't get hung up on $1,000. Could be 2,000, could be 800, could be whatever your cash flow is. Pay it towards your lowest balance first. What happens? I go from 360 months. You throw C3X at it. Holy moly. We can cut that time in half. We could cut that time by 75%. We can cut that time by 85%. Just depends on how many properties you have and how fast you want to go, right? So deferring gratification goes down to investment objective. Some people can defer the gratification. Some people can't. That's okay. That's why it's important to have some person on your team, like Greg's team, to walk you through that strategy, right? So that's what the calculator does. Fires up guys like me, because what that number means is, holy moly, I'm getting to, 10 grand by 2039 rather than 2047. That's a big deal for guys like me, right?
Amazing. It's amazing, man. Being able, we're just talking about this, right? Working with a team, or you mastering this yourself, you're able literally to just funnel your payments that you were making, the same amount of payments you were going to make, funneling them in a strategic manner, and you're at your passive income goal 8 years faster.
Right.
That's financial engineering. That's really incredible. And then not to mention that all along the way, you have additional cash flow at your benefit, right? That's always a wonderful thing. Now in this model, we're taking that cash flow and we're applying it to the next mortgage, which is incredible. But just simply having that cash flow at your disposal, which does rack up to $3,000, $5,000, $7,000 a month until you get there, is a really wonderful luxury for you as well.
Amen. One thing I'll add here, maybe a teaser for the next show.
Yeah.
Is we didn't stop there, right? It's like, what is it? Tim Cook now. And one more thing, right? From Steve Jobs. As we all know, and Greg, I'm sure you've taught on the show, like real estate, we're just talking about one profit center, right? we're just talking about the cash flow. That's it. But real estate has 4 profit centers, right? So what this calculator automatically does is it shows you that profit center, right? Your cash flow, right? But it also shows you what your ROI is by paying down that principal, not even assuming C3X, right? Just the basic, most conservative approach. I know I'm making another 3.5% on my money in this scenario just by owning the real estate itself, because I'm paying down my mortgages. Then on top of that, I know I'm getting another 3% in this hypothetical scenario because I'm getting tax benefits from it. So you throw in your tax bracket and boom, so say I'm in the, I don't know, what are tax brackets these days? They're changing all the time, right? So say you live in California like I do, and we pay basically 50% taxes, right? So I know I'm saving another 4%, right? I'm making 4% return on my money just from taxes, which we can go into all that and how that means and all that works in maybe another show. And then, you're investing in like a high growth state like Florida, maybe things, what's the appreciation rate been in Florida?
4.3% per year on average since 1991 every year.
Oh, so that, hey, in 1 year, I'm making another 13% on my money, right? So the strategy we've been talking about is just this one up here, this return, but I know I'm making 3 other profit centers on this thing that total up to easily a 15, 16, 18, 20% return on my money every single year, right? And if you can just say, well, I don't need this one cash flow in my pocket, boom, you go back to C3X and we can speed things up and make it go even faster. That's the beauty of real estate. That's financial engineering at its best, is understanding, here's the whole picture. Here's how money's actually working for me. Here's the tax benefits I'm getting. Here's what my cash flow does. Here's how it's growing over time. Here's the whole picture. Cool. Now I can make a best decision for my portfolio, right? And that's what this calculator can help show you. With someone who, knows what it does, knows what it works, we can show you and walk you through and say, here's what I would do in your shoes for John Doe, Jane Doe, Greg Cohen, your mom who invests, and owns property. I know, like that kind of thing. It's unique to everybody, which is cool.
Paul, this is great, man. It's like you're living in my head, bro. This is all I get fired up about as well. So let's start to test this a little bit. So a common question is, how do I make the decision of what to pay down first? Is it always lowest balance, or does the interest rate matter?
Sure.
So and I saw that was a question here too. They said, well, the interest rates are all 4%. Maybe we could go through and kind of play that out and show how we make the decision.
I love that. So let me blow it back up and just show you this, right? So we built that in here because it was a very common question. So in the drop-down menu, you can see we call it avalanche strategy. We don't talk about that one very much because we don't really use it that much. But for whatever reason, if you have a high interest payment, you want to get rid of that one first, you can choose that. You can just choose the order they're entered on the table. You can choose, you can put a custom thing. I want to pay off this highest price point first, or whatever it is, right? Or the one that I get the most cash flow from first. You can customize highest to lowest of whatever you tell it. Let's first then change the interest rates, Greg, because what we did is we put all the interest rates at 4. So in order to show the difference, let's say half of them at 4 and half of them at 5. Is that cool?
Perfect.
Okay. And let's just see what happens. Or you wanted to go higher just to make it more of an extreme example?
Yeah, sure.
You tell me.
Let's go 4 to 7%, and then it'll make the example a little bit even.
Just to kind of show the concept with a little bit of more aggressiveness. So if we do C3X, which is the lowest balance first, I'll blow this up for people to make it a little bit bigger for them. So if we just do the lowest balance first, we're paying the first one off in 2023, and we're paying the last one off in 2039. Okay, so let's remember that. What if we go to the avalanche, the highest interest first? What happens? So we're paying first one off still in 2023, a little bit later in the year. It was January 2023. Now it's October 2023. But the last one gets paid off a little bit faster in this particular case as well, too, right? So instead of 2039, I think it's 2037. Pretty cool, right? Now, it may not be the most realistic scenario, because usually you don't have a 7% interest loan, but maybe you do. And that's the beauty of throw it in the calculator, check it out, do what's best for you. Every portfolio is going to be fairly different. And that's the cool thing. So in this case, we're still shaving a ton of time off, right? We're still shaving years off of this scenario. And if maybe you have a super high interest, maybe you got, like some kind of private money on a deal and you got 8 or 9 or 10% on a deal. You want to pay that puppy off. Cool. Throw that in here. Okay. This one, I'm paying 12% on it for whatever reason, right? Cool. Pay that bad boy off, right? You can still pay it off in October 2024, right? And it speeds everything else up a little bit quicker. Totally cool. That's the uniqueness about this. What we do is usually our loan interest rates are fairly uniform, maybe between 4 to 4.7 or 4 to 5.5. And there's not that much difference in variability in it because most of what we do is just kind of the government backed 20% down. But maybe in your portfolio, you have maybe a bridge loan or a private money loan or something. You really want to pay it off really quick. Cool. No problem. We can do it in that strategy.
This tool has taken something that was largely field-based answer to something that is objective and that everybody can use to their advantage. I'm with you. Largely, you go with the low balance first because your interest rates are generally uniform. But until I had this tool, I didn't know.
Exactly.
Right? So the beauty is that you can run an analysis. Our team can run an analysis for you so that we have an answer and give you that guidance again. I mean, what is it worth to reach your financial independence goals 1 year earlier? Right? It's worth a lot.
Being able to tell that boss, I'm done, or whatever
resource. Yeah. So this is really amazing. For those who are watching the show, if you have additional questions, you want us to try to break this thing, you want us to test it out a little bit, fire those in.
We got some questions.
Yeah,
we got some questions. All right, let's jam through some of this. First one, real quick. Eddie Harris asks, "Where is this spreadsheet? Is this something that they can download? Can we put in the group? Is this something that you need to go to chatwithjwb.com to get?"
Yeah, I mean, honestly, it's really helpful for those folks that already are clients and that have a plan for us to walk you through this so that, number one, we can, of course, walk you through the spreadsheet, but so that we can learn, so that we can know, so that we can be that financial resource for you. So this is typically something that we do internally during our planning calls with clients. We'll see what we can get out there for the group, for folks to be able to have something that they can use as well. I don't know what we'll be able to do there, but definitely if you'd like to be able to take advantage of this for your portfolio with JWB, call our office, talk to your portfolio manager, and we'll be able to have that conversation with you.
Yeah, my analogy for that is like it can be a loaded gun, right? Like in the right hands, it can do a lot of really good things and help protect people and help people. But it can also, you can get lost in the abyss of like, whoa, what happened? Greg and I were messing around with this 5 minutes before the call and we broke it, right? So let's be very real, right? So all of a sudden it's like, whoa, I'm getting a really weird result. What happened? It's Excel. It can get broken, right? Like, it is not, no one tool is the end all be all, everything you need. Let's be very frank. It's just not, right? It's the concept and knowledge, and the tool does all the math for us really quick. But you need, like even me, I'm looking at this sometimes like, I think I broke this. And I go back to the original one and I redo it again. And yeah, I had broken it. So you need that experience and knowledge and that kind of guiding hands to guide you through it, Frank. So.
Got it. All right, let's jam through some questions. Her Francois says, "Paul, I see your model that you don't include monthly escrow payments in your calculation. Does it make sense to include escrow payments, or doesn't have much meaningful impact?"
Custom to each individual is the short answer, right? This is designed, no exact scenario. What this pumps out is not going to happen in real life. You may be 1 month later, you may be 4 months later, you may be 2 months earlier. It's a tool to get you the concept and strategy. Real estate never performs exactly how we want it to. You're going to have some maintenance. You're going to have some vacancy. It's going to happen, right? So we did it basically just off monthly principal and interest if you want to hold reserves. And this is where you can say, okay, I'm going to put a little bit set aside for maintenance every single month. So maybe I'm going to put $85 here. Cool, no problem. You want to say, oh, hey, I want to, not hold aside. Maybe I'm $125 a month. I want to get aggressive. Cool, fine, no problem, right? So it's a tool to give you that flexibility. You want to set aside extra reserves, totally cool. You don't want to, not a problem, no big deal, right? And this is just designed to show you the principal and interest, right? Taxes and insurance. The net cash flow is net of, you put it in there. It's net of your escrow payments. It's net of your taxes and insurance. It's net of whatever it is you want to be net of. That's what you would put in that cell, if that makes sense. So.
Yeah, and that answers Eddie's next question, which is with net cash flow, do you take into account months or time when property is not rented, repairs, et cetera, right? So there's going to be a variability in there. Chris Parson also put in the chat how he loves the cool aspect of the fact that rent prices increase. So all this is going to change. And then
exactly. It actually, so I like under promising and over delivering, right? So like I'm putting in rents now, rents are going to escalate over time as well too. Like I get that automatic rent bump after year 2 to 1025 instead of 10,000. I love that, right? Especially with my JWB leases. Love that. Happens all the time for me. Love it. It's like Christmas. This happens faster, right? So
love it. Love it. Cool. All right. Danette Colvin has a question. Does C3X only apply to properties purchased with JWB? Can it be applied to other properties purchased elsewhere? Like you can put in basically any property in here, right? It's
put in your portfolio. Yeah, it's like any deal analyzer, right? Put in your portfolio what you currently have. You inherited a property from Uncle Jimmy and Aunt Jenny. Cool. Throw it in there. You want to potentially look at your own primary home and throw it in there as well too. Maybe you want to pay off your primary home. It doesn't cash flow for you, so I wouldn't recommend it, right? It's not the best financial investment decision, but maybe that's a huge desire of yours. Cool, throw it in there, right? Any, could be a 12-unit property, could be an apartment complex. You could put I bought this thing for $4 million. My down payment was $1 million. I owe $3 million. Cool, no problem. It's a calculator. It's not just a single family home or it's a financial calculator for any property.
Very cool. All right. We have somebody who is returning from France, and Anonymous Attendee asks, very informative. Do you recommend to lowest mortgage versus highest interest, or rotate few years in each mortgage so that the high interest period passes on each with more pay down? Please advise and share your thoughts.
Good question. I think it's dependent upon each situation. So it's people who attend my live classes always hear my favorite answer is it depends. It depends. It depends on your situation. If you have something like this where you have one that's like 12%, and it's killing you, because that's $2,000 a month compared to the $800 a month you're usually spending, and you want to get rid of that thing, that makes a lot of sense, right? If I've got, 5.25%, whoops, that didn't work. Wrong cell. See, don't break the Excel sheet, right? If you've got 5.25 here and everything else is in the 4s, probably do lowest balance first, because but here's the cool thing. Let the math tell you. What real estate is, and what Greg, you mentioned it comes with a lot of emotions. It comes with a lot of feelings, because it's houses. Houses have emotions tied to them. In our culture, it's a very emotional thing. This allows us to be numbers based and facts based. Just run Avalanche, which is highest interest, versus C3X, which is lowest balance, and let the calculator punch it out for you. Whatever result you like better, do that, right? But what I wouldn't do is waffle in between. So he mentioned that there a couple of years of this strategy, a couple of years of that strategy, you're going to get a muddled middle of the road result. It's not going to be as fast as if you pick a strategy and stick to it, right?
Okay, so that's a good clarifying factor. So this is one of these, you look at it holistically, you run the numbers a bunch of different times, mess with the spreadsheet, break it a couple of times, fix it a couple of times, do it again. Once you figure out what to go with, you stick with one strategy and you do that long term.
Measure twice, cut once.
Measure twice, cut once. There you go. There was another way that you said that before too, right?
2 parts prep, 1 part execution.
There you go. I think there was one more. Is there another one?
Yeah, we're going to move on.
All right, cool. Cecile Jamay has a question. Being analytical, I simply love listening to you, Paul, and you just switched a light bulb in my mind. In that same concept, I have been investigating using home equity line of credit to pay off your finance properties faster. What are your thoughts around that?
It depends. My favorite answer. It depends. So I have a home equity line of credit, right? What I do with it is I use it to expand and acquire, not to pay down current long-term debt. So a home equity line of credit is designed to be a short-term debt credit facility. All that means is let's talk very frank, brass tacks. It's short-term debt. It's designed to be short-term debt. Don't confuse home equity line of credit with long-term debt. Getting a 30-year loan for anything less than like 6% is amazing. As my opinion, my advice, I'm not a financial advisor. I'm not a tax CPA. I got to cover all this. What I do, I get as much of that as I possibly can. Right? Take as much 30-year, anything less than 6%, take it, keep it, hold it, love it. Okay. Take the short-term debt as well too, and let that help you acquire things faster. I wouldn't pay off long-term debt with short-term debt because you can get in a bind pretty quickly. It is my 30-second, probably 2-minute answer, right? Greg, I mean, do you see it differently?
I'm right there with you. I love your main thesis that it is short-term debt. I love your main thesis, which is when long-term debt is as advantageous as it is right now, you gobble all that smart long-term debt up, especially on assets that pay for themselves. So I'm with you there. I'll add a couple more points to this just to kind of take it a little bit farther. Paul's answer is the same as mine, and that's even in the face of your interest rate being lower on your home equity line of credit than what you could get for a mortgage, right? Your home equity line of credit, I have one on my house. It's 3.75% right now, right? But I go out and I take debt on at 4.5% or something like that. And the reason that I do that is because what Paul talked about. And the other thing is that there's a limited opportunity for home equity line of credit, right? It's limited by what your equity is in your house. For all intents and purposes, with the long-term debt, you can acquire 10, sometimes 20 mortgages without a set dollar figure. You can acquire millions of dollars of long-term, incredibly advantageous debt out there. And so the ability for you to be able to acquire that long-term debt, it's worth it for you, even if you have to pay a point more or even 2 points more, right? It's worth it for you to use that short-term debt as short-term. Use it to acquire the next property for yourself, maybe as a down payment if you need it, and then go out and get that long-term debt at 4% or even maybe 4.5%, and then rinse and repeat and do that over and over and again. If you do that and you put it into a calculator like this, you'll see that your timeline to get to your financial independence will be less than if you just use that home equity line of credit to pay off that one mortgage right off the bat.
Amen. Good. Love everything you just said. Love it.
Guys, the only thing that I'm a little, so I think that, I mean, this is really landing on the community, right? Like Leo says, Paul, that's a great explanation of HELOC's use. That's an additional info I learned today based on your experience. Danette Colvin writes, now that makes sense. I think it's awesome, right? Like use the HELOC wisely. As somebody that isn't as bright as Leo and Danette and maybe doesn't have as much experience in real estate, I understand the home equity line of credit thing, right? Like you take out equity from your house to buy, to put down that money to buy something else, right? How is the home equity line of credit is paid down? How? Like what pays that off when you're putting that into a house?
Yeah. So it's like think of it like a credit card, right? Your home equity line of credit is basically like a credit card. It functions most of the time. Every loan's different, but you got to ask your banker, but it basically functions like a credit card. If you borrow it or use it, you got to pay it back and pay interest on it. Okay. So you may have a $200,000 line of credit with your home equity line of credit, but maybe only you use 25,000 of that. Well, you're only paying interest usually on that 25,000. That's what you use. I have the other line of credit there, but it's not used. So I just pay on what it is. What happens is you say you use that as your down payment. I'm going to put 30 grand down, 40, 50, whatever it is. Use that money as a down payment. Okay. So let's use round numbers. I have to pay the bank $300 a month on that. Whatever that number is. Okay. I have $300 because I borrowed 50 from the bank to use the down payment. I got to pay the bank $300 a month. That's just my home equity line. With me?
Yep. I'm taking notes. Yeah.
But that property I purchased, right? I'm going to get a loan on that. And I owe the bank everything we've seen in C3X. I owe the bank, $600 a month or whatever it is on that. Okay. Well, you also owe the bank that $300 for your home equity line of credit. So you have to run the analysis and say, okay, can I pay the bank back for my original loan, but also pay the home equity line of credit back, right? So you got two loans you're working with. You see how we can get over leveraged really quickly?
Yeah.
Right. So all of a sudden I've got a loan here and a loan here. what happens if I go vacant for 3 months, which may happen. Greg and his team are awesome, but vacancies happen. Trust me, I know. I own dozens of properties and I got vacancies all over the place. It happens. It's part of owning business, right? Part of running real estate. So can I float, loan 1 and loan 2 for 3 months? Do I have the reserves? Do I have all those, so you see how it's like, okay, does this property pay enough for me to pay my first loan and the second loan on this thing, that home equity line of credit? You have to look at that at the beginning before you say, ooh, piece of candy. The bank gave me 200 grand. Let me go invest it. Great. Let's make sure we run the analysis the right way so we don't get over leveraged, right? What we just described happened in 2008, 2009, a ton. People got tons of lines of credit. They used it to pay down or put down payments on it. And they were doubly, triply leveraged on properties. Double leverage means exactly what we just talked about, right? I'm taking a home equity line of credit, which is loan 1, putting it as a down payment. I've got loan 2, right? Something goes wrong, hiccup happens like 08 and 09, all of a sudden you're in trouble because you got multiple things, right? So you have to be very careful not getting over leverage, which is why when we introduce HELOCs, I like them. They're great. I use them, but it's a pretty advanced strategy. You better have a good team around you to make sure they really walk you through, does this make sense or not in your unique situation with your loan and terms and all that jazz, right?
I love it. You're definitely right. That's an advanced strategy. And the other thing that I'd point to here is if it's something that you're going to be employing, we can go right back to this cash flow calculator, right? We can put that loan balance, which will be the lowest loan balance, most likely for your portfolio. And we could attack that first home equity loan balance there. And you could see how many years until you have that paid off.
Yeah. You call this one HELOC, right? And you're not purchasing anything from it. And your mortgage balance is $250,000 or $25,000, right? And your interest rate's 4% and it's 30 years, but you're not getting any cash flow from it, right? Throw it in the calculator, let it work for you, right?
Exactly.
So yeah, it's a great point, Greg. It's great. So.
Love it. Let's knock out 2 quick questions before we get out of here because it's 1:30 already. Paul, I don't know, with your over the top energy, like the time has flown. I can't believe it's already 1:31, man. All right. Daniel Lee asks, can you clarify what the $950 in column K represents? It doesn't look like it's being added to the current cash flow total below. How does that factor into calculations?
Yeah. So that's just once the property is paid off, that's what happens. Your cash flow goes up. He's actually correct. This was an old version that Greg and I broke. This should equal both, right? So he's right. There you go.
Daniel Lee.
Right. But yeah, this is just, it's cash flow with payoff. Once the property and you hover over it, it gives you a nice little explanation. How much net cash flow you're receiving after the mortgage is paid, right? So that's what that is. Yeah.
Got it. All right. Good question, Daniel. Cecile Jamet has one final question. So I have refinanced all my properties last year. I am able now to pay additional principal across all properties, but hearing you, it seems that you would have advised to combine additional and higher principal down on one property first rather than across all 10 properties. Is that correct?
Amen, sister. Yes, 100%.
Love it.
Well,
absolutely.
It depends on investment objective. Without knowing anything about her, just free advice worth what you pay for it. Yes, absolutely do that. But have a conversation, see if that's what she wants. I don't know if even paying extra principal is good for her yet. Maybe she needs the cash flow because she needs the cash flow now because her goal is now to get rid of her boss or retire or whatever. I don't know, right? But if her goal is no, I got 4 years or 10 years or 5 years or whatever it is, then heck yeah, let's play. Let's do some, not play, play's the wrong term. Let's do some financial engineering. I call it play because I love it. And let's run the analysis and see if we can get there faster for her. Heck yeah. Right. But if she is going to pay principal, paying it towards one will make things go faster rather than paying towards all.
Outstanding, man. Do you mind unsharing that screen so that we see a full picture here when I ask you? Yeah, Paul, we know you're not Mr. Social Media. That's not the award that you've won recently, but what people are loving this call. We're having really, really great reactions in the chat.
Yeah.
Just really, really good stuff just all the way around. It's great to have our usual family back in here. Tons of knowledge exchange in the chat. People really, really made a lot of sense to them. If they want to contact you, if they want to get involved with Fortune Builders or Equity Street Capital, what's the best way to contact you?
Yeah, I think the best way is through Greg's team, honestly. right? I think Greg's team will be able, because they work with him the most. They know when that's the best for their plan. Greg's team has done a wonderful job. We've trained Greg's team on this. Greg's team has even improved all of this with us. Iron sharpens iron, right? Like Greg's team is phenomenal at all of this. So I would say, the same way Greg told us, get schedule a chat with them. And then when it's appropriate for your plan, if they need to get back in touch with us, they totally can, right? And Greg's team knows exactly, they can get him on my team's calendar and knock it out, right? So
perfect. So chat with JWB.
Yeah.
GC, you were going to say something?
I was, our organizations have been working together for 15 plus years. We work so well together because there's not one type of investor that is going to get all the answers from my team or from Fortune Builders. And when we see an opportunity for that investor to go to Fortune Builders, we're going to put you in touch with Fortune Builders. Just the same with Fortune Builders is going to put you in touch with JWB. So we're attached to the hip. Whether or not Paul Shively wants it, he's never getting rid of me. Yeah. It's been an awesome partnership, man. Thank you for doing such a wonderful job.
Amen. Best partners I've ever had. So best partners I've ever had.
Best partners they've ever had. All right. Well, awesome partnership. Awesome call, Paul. You brought it today, man. I forgot how much energy you actually have. I was not conditioned to it. It kind of blew me away to start. I rented someone's mouth. I think is where Lee had it. Totally overwhelmed, but man, you really informational, really opened my mind up. I want to tell everybody good news, bad news. Bad news is GC is going to Bandon Dunes again. So we're not going to have him on Thursday. But the good news is we got Drew Barnhill that's going to be joining us on Thursday for the JWB Rental Property Investor of the Week, where we're going to go over our typical JWB property and we're going to pick Drew's brain on the properties that he's purchased, how he would analyze the deal. I think it's pretty rare when a company allows you to all gather around and ask questions about their product without anybody that works for the company in the house, right? So that's what's happening again on Thursday. It's going to be a open informational share, again, instructional. I'll do my best to play the Greg Cohen in that call. I obviously can't do that because I'm not such a good golfer, but I know that Drew's got some chops, man, and he's going to be able to bring a lot of value for everybody. Looking forward to it with you, Drew, also, that we see you in the chat. And I hope everybody got value. I feel like everybody got a ton of value from this call. If you're looking to find out about rental property investments, you were clearly in the right place. You're looking for property management advice. Not a lot of it today. We touched on property management a little bit, but you're in the right place here going forward. And again, if you want the edge on the Jacksonville market, you're in the right place. The next move to go to personalize this for yourself, go to chatwithjwb.com. We want to thank you all for showing up today. It was really great to, again, have the issues with the emails resolved today, have our usual crew of like 40 plus in the house. It is so much better when you're here. We promise that we're going to continue to be better as far as fixing the little glitches on the technical side. That one's on me because I'm kind of a tech idiot, but we're improving it going forward. And we never take it for granted that 40 plus people took an hour out of the middle of your Tuesday to hang out with us. Thank you so much, GC. Thanks, Paul, again. GC, I'll give you your last call, man.
Yeah, it's so nice to have everybody here. Thank you guys for being here. Having 40, 50 folks show up each and every week is amazing. And then, I'll tell you, Pablo and I last week, we had the technical issue. We didn't get to send the email reminder out. We had a lot less on the call and we were like, man, are they going to come back? And you all came back with flying colors. We just love you guys. So thank you so much. Paul, I got to tell you, man, you brought the heat today. I don't think there has been another show that has been carried so well by another guest from start to finish, right? I mean, Pablo and I, it's good that he was using rented lips today because I didn't even need to talk very much. I mean, you are so inside my head. I know that we think very much the same and, we're of the same mold. Thank you so much for being so prepared, for bringing such value to the group here.
Amen. That's why I do what I do. I love helping folks. I love helping them on their financial journeys, man. So
you're on to be in the Not Your Average Investor Show Hall of Fame, brother. I tell you that this is number 2. You have earned the number 3 spot coming back to you. Just so you know, you are taking the lead.
Jacket. Go for the 5-time SNL jacket.
Thank you, everybody, for being here. If you'd like to be a part of what Paul was talking about here, reach out to my team. This is the conversation that we love to have. Whether you're a new client, whether you're a current client, whether you're thinking about it, this is what financial engineering looks like and what we can do for you. So I will see you. I will be on the show watching a little bit on Thursday to see Drew, and then I'll be back next Tuesday with you guys, and we'll see you then. Thank you, everybody.